you prepared a whole slide deck here with a bunch of awesome information. So maybe we should just jump into this to start. We're starting with the total revenues, I guess.
Yeah, so another quarter, another record for Tesla. And, what's important to know is that, everybody, the entire financial conversation surrounding Tesla is on that top line growth. And that's been the story since inception is, increasing the total addressable market that Tesla has been working on, starting with the super high end, luxury vehicle market and now getting into the mass market. So it's been an incredible growth story at the top line, delivering about 50% annualized growth since 2013. So it's been absolutely phenomenal. However, I think what's going to happen is, although that growth trajectory I think will continue, I think the bigger story, and this is something I think people should pay a lot more attention to, is the growth in efficiency. And the concept of that is known as return on assets, or return on invested capital, or return on equity, any of those ideas. So as we see continued revenue growth, as new products start to come online, such as Cybertruck, the Semi, and then the explosive growth in Tesla Energy, I think is still to be seen. The growth rate is still going to be fantastic. But keep in mind, growth is great, but if it doesn't come at a high level of efficiency in terms of the total Capex spend, then investors will ultimately discount the shares. And I think we're going to talk a little bit more about that, in future slides here.
Yeah, and so I kind of wanted to set it up even more than that too, which is this really cool concept of like the financials for Tesla are really clicking. Like we've all, been so excited about the technology and the products and the vision of Tesla and Elon Musk, but now it's like the financials are clicking into place of like, it's not just the products that look and feel totally different than a car you would drive on the road. The financials and the way the business is actually maturing in the financial statements is looking totally different than a traditional car company, and like justifying all these crazy new types of valuation. And it seems like we're really starting to get the evidence of that. And especially this Q3, like record cash flow profits in the midst of a pandemic, everyone else is shrinking. And what's most impressive to me is like the way the margins and the profitability of this revenue growth is happening all at the same time. And like, we're about to dive into that, which I'm so hyped on. But yeah, I think it's really awesome. I just want to take a second on that trailing 12-month revenue chart, because we started to see it tick back up to like 28 bill. And so now I think they've got the Model Y, this China thing that's going on, Berlin. Like, I just think we're, Tesla, I was looking at their market cap today. It's like what, 390 billion versus 12-month trailing, 28 billion trailing revenue. Like, we're probably only at like 8 times current revenue and shrinking, like compared to the price sales of a lot of these other tech companies. Like, it didn't even seem that crazy. But yeah, I don't know. I'm curious if you had any comments on like the gross profit or the revenue chart before we move on, because I think these pretty self-explanatory, but have totally, like especially the gross profit as well. Like, I wonder how much of this has been manufacturing improvements versus economies of scale versus FSD. Any commentary there?
Yeah, so that's the next slide is that although we've seen impressive revenue growth of 50%, the gross profit growth, and this is the growth in the total gross profit dollars, not margins, has actually exceeded that number. And that's important to see, is anytime a number below the revenue line grows faster than revenue, any profit line below revenue that grows faster than revenue, it's indicating the presence of operating leverage. And so now that we see gross profit exceed the growth rate of revenue, that's telling us that Tesla is hitting scale now, because there is a fixed cost component within the cost of goods sold, which hits the revenues right after. And so with increasing asset utilization, as Tesla leverages their existing asset base even more and more, by removing the bottlenecks, like you mentioned, like improving design of the cars, and even improving the manufacturing process of cars, we see that the gross profit will continue to grow, in my opinion, faster than revenue growth for many, many years. And a part of that is also due to the presence of FSD as well.
Yeah, and I wanted to just throw something in there, which is Tesla was really compressing their average selling price for a couple years, like Model 3, the 35,000. Like this was a trend for the past like 5 years thinking of Tesla. It was just kept average selling prices kept coming down. And yet now, through all that was said and done, they've actually not only maintained margins, but last quarter actually bumped up margins. It's like almost record level in the recent history. And so that's been insane to watch as the average price comes down for them to hold and even increase those margins. And now I'm thinking, okay, we have FSD prices going up. It's not like the Model 3 and Y are really going to get much cheaper. Like a lot of, this new economies of scale and efficiencies without the average selling price dropping means we could have a huge incremental lever on margins. And they've just been,
Right.
like they were sandbagging Model Y production. The other thing they were sandbagging maybe even more was Model Y margins.
No, and that's a critical point. I think Tesla is going to, and in fact, they stated this on the most recent 10Q filing, is that their goal is to increase the affordability of their cars. So that's why, in my view, in the long run, I don't see Tesla's operating margin or gross margins really expanding all that much. I see them using any gains in gross margins to offset with price cuts. And that's why,
But for hardware, maybe not with software though, because I feel like
correct.
FSD doesn't jive with
Yeah,
that, right? So how does that all
that's
work?
correct. Yeah. Yeah, I think that's exactly right. I think FSD won't ever see a price drop. It's going to only increase over time as they get closer and closer, to full autonomy. But I think what Tesla's strategy is going to be is to use these efficiency gains as well as margin gains coming from FSD revenue recognition to continuously pressure the average selling price down. Because Tesla, I think, wants to be and it's consistent with their mission, right? Their mission is not to sell super high-end luxury cars to, the 1%. They want to become ubiquitous. And in order to do that, they need to continue to push that average selling price down. So I think, and this is just my opinion, but I think that gross margins will remain fluctuating somewhere between, 22 to 20, I don't know, at the high end, maybe 28% in the short run. But we're going to see gross margins stay in that range, but gross profit in dollar terms going to continue to rise dramatically, exponentially, really, because they're going to continue to put price pressures on the hardware that they're selling,
But
meaning the
but
cars themselves.
Yeah, and that's fascinating points there. And I guess what I'm really curious about is like, okay, well, that drop of $40,000 cheapest Model 3 or Y to $25,000 Model 2, which is the next, cheapest hardware you're saying, in that 2-year time frame, I believe the price of FSD could go up 15 grand. So the hardware is going to
Right.
drop 15 grand, but the FSD is going to go up 15 grand. And yet Tesla's cost of production of that same $40,000 asset is maybe, 20 grand versus 34 grand. So now all of a sudden we
Right.
just went from a structural, because so much of it's software, to a 50% margin from a 28% margin, which is where we're at last quarter. So I'm curious, and this is what Elon Musk was hinting at so much on the conference call, like the entire margin structure, the whole entire way Tesla works is totally thrown out the window with FSD. So I'm curious, like, this is one thing I've personally been struggling so hard with is, okay, it's easy to kind of model out the vehicle business at this mid 20% gross margin, but I feel like we're not calculating in a true 2K FSD price hike with another true 2K FSD price hike with high attachment rates, with high recognition as they roll out that functionality. Like, you know what I mean? It feels like they're not gonna be able to drop the ASPs fast enough for the hardware to offset this rising FSD price, and we're gonna get gross margin crank up into the 30s real quick. You know?
Yeah, and see, and this is why I really wish Tesla would, one day, at least in the short term, like sometime in the next year or so, start to break out FSD revenue and FSD, margins,
Ooh.
apart from the automotive business, because I
But
think
yeah,
this is the
how should
key
they do
thing to
that?
know.
Let's riff on that. Like if Tesla was to do that and break out FSD, because I think you might be onto something really big here. How would they do it? What would that look like? Because this could be a total structural way for Wall Street to think about and investors to think about the company as Tesla themselves thinks about how they monetize their own technology and assets is truly the Tesla network, this autonomous software. So they're gonna, right? So I love what you're going with this.
Yeah, the answer to your question most directly is if you look at how Amazon does it. If you look at Amazon's quarterly shareholder deck, they break out, international retail sales, U.S. retail sales, and AWS in both revenue terms as well as on operating profit terms. So they kind of break that out, and you can see directly that, you know, AWS is around, I think it's like around 12 to 14% in terms of total revenue, but it's a monstrous, you know, 50% of operating profit because of how high margin it is, right?
Mm-hmm.
So I think that's going to be a similar case as we go forward here. You know, now that FSD, you know, the new rewrite is out, if it really gets a lot better, I see that becoming a major component of operating profit, but still a very small component of total revenue. But because it's such a different animal from the hardware that they sell, I really think and I really hope Tesla one day does break it out, because there's going to be an important, you know, trend to make sure that people understand, which is that margins at the operating profit level are not only going to go up because of AWS, but because of increasing efficiency in their car design and their manufacturing process. And now with what we found out on Battery Day, you know, significantly decreasing production costs due to the new cell, the 4680 cell, and in how much less Capex is going to be required, you know, per gigawatt hour of battery production that comes out of there. So, you know, there's going to be simultaneous tailwinds from both, you know, operating profit from hardware sales as well as operating profit from FSD. So that's why I think people should know the difference between the two. And I really, really hope Tesla does start to break it out, because I think it's going to show a lot. And without that, unfortunately, we won't have any idea of how much of Tesla's operating efficiency is due to FSD versus due to increasing efficiency in manufacturing.
Right? Because I'm just thinking off the top of my head, like, what's 10,000 times 100,000? Because I'm trying to get a sense of like how big is it today every quarter? Like how big is it of Tesla's operating income, right? It's like a billion. If 100,000 cars got a 10K FSD package and we recognized it all in one quarter, that would be like a billion in profit, right? So I don't
Yeah.
think we're that far away from that. You know what I mean? Like even with the current pricing, we scale up to 200K cars a quarter pretty soon. The attachment rate goes up a little. Soon they raise it to 12K. So we're a little more than a billion a quarter in basically hard cash flow from this software option. You know what I mean? So now I'm almost like, wait, so you're telling me just out of all Tesla's business, we're worth 390 billion and we're almost at a billion a quarter run rate of this software like dividend. That's 4 billion a year. That's over a 1% yield on the current market cap of cash flow from just software FSD sales today. And they triple the price of that. And then they triple the number of units. You know, that 1% yield goes to 10% quickly. Like, you know, I've been thinking that I'm going insane because I think Tesla stock is still pretty cheap here. The more and more
Yeah.
I'm like, damn, I just totally drink the Kool-Aid here. But like when you start to play this out and you're like, okay, well, what are they going to do with the wiggle room? Are they going to keep dropping prices? Well, no one else is, or keep raising margins. Like they're just, it's like Elon's the king in the castle here to decide with how to divert this excess like margin wiggle room.
Yeah, and see, this is why I think it's really important to look at the return on assets. And this is something I've been pounding for a couple of years now, which is that the biggest knock on investing in autos in general, auto manufacturers or any type of hardware manufacturers in general, is the capital intensity of the business itself. So why do auto companies trade at such low valuation multiples? Like GM, Ford, Volkswagen, Toyota, they all trade at under 10 times earnings. And the reason why that is not just because they don't grow all that fast. Because keep in mind, Tesla has phenomenal growth runway ahead of it, but ultimately, no company can continue to grow at an above average rate forever, right? At some point, you reach saturation, and at that point, shares will then ultimately trade down to the industry average. And this has happened across the board
Our
for
growth
all
rate
auto
will
manufacturers.
have to compress to that of humanity's essentially.
Exactly. Yeah. So the fastest you can possibly grow in the long run, and I'm talking about the ultra long run, is the rate of global GDP. That's the fastest that you can possibly grow. If you are a ubiquitous car manufacturer and you've entered every market on the globe, and now you're just simply refreshing your cars every year or so, then the fastest you can possibly grow revenue is at the rate of global GDP. So at that point,
So why, I think I never go into this. So I'm like, to play devil's advocate. So why were all the automakers in the world valued at 500 billion of this opportunity at maturity, and yet Tesla's already worth basically 500 billion? You know, just I'm super rough numbers here, basically saying that they would already be at maturity dominating the whole industry, right? And so
And the
that's what the
answer,
skeptics and
yes,
shorts would say. But
yeah.
there's a whole caveat there, which is your point of the capex, right?
Exactly. So there's two things that influence valuation multiples today, right? One is growth rate. And so that's why you have to look at valuation relative to your growth rate. But also in the long run, it's not just the growth rate, because as we just said, growth rate will ultimately converge down to the global GDP growth rate. So at that point, the factor that becomes the most important for investors is efficiency. And that's why Toyota, for example, is the biggest automaker in terms of, before Tesla overtook them. Prior to Tesla overtaking Toyota, Toyota was the biggest auto manufacturer by market cap, even though they sell less vehicles than Volkswagen. And that's because Toyota has been the most efficient automaker on the planet. They have the best return on assets. So it's efficiency that ultimately, drives valuation in the super long run, even if you don't have very, very high growth rates. And you can see that for many other companies like Coke. For example, Coca-Cola, they don't exactly have, eye-popping revenue growth, but they still trade at a premium to consumer staples. Same thing with Procter and Gamble. They don't have, they're not going to rock anyone's socks off with their growth rate, but they trade at a premium to the sector that they belong to. Why? Because they have above average efficiency on their asset utilization. So the
Interesting.
reason why people are so excited about Tesla is
But
not
but
just the growth
yeah,
rate.
but those companies I would say have increased it like ROI because of like some BS brand value that they built 30 years ago and are still leveraging these legacy distribution partnerships for, as opposed to like Tesla's like rapid growth and like technological moat, as opposed to like some lame process like legacy systems moat that those companies have. That's why I'm like almost it's like it is a good analogy on the paper financials, but when you're diving into why, like Tesla's premium is even more justified because it's not just a label that's a brand. It's actually like super technology under the hood. And what's Tesla's almost unparalleled is because they're defying the norms of high ROIC with the high growth rate at the same time. It's almost
Mhm.
like and that was kind of why I wanted to have you on too. It's like, isn't this like a once in a lifetime business case study of like what other company, it's like they're breaking all the rules pretty much.
Yeah, exactly. And that's why I think that the reason why Tesla has overtaken Toyota is because of the growth rate that we're seeing right now, but also because if you look at this other chart that I put together with regards to the return on assets, and the way that I define return on assets is basically looking at trailing 4 quarters of EBIT divided by divided by the average asset base over the last 4 quarters. So it's trailing 12-month EBIT divided by the average total assets,
And why is
and we
this
see
such an important metric or the best way to gauge it?
because it's telling us how efficiently is Tesla utilizing their asset base, right? For example, let's say you have two companies. They both are doubling revenue each year in and year out, which is awesome, right? But what if one company requires capex spending of $100 million, and the other company requires only $50 million of capex spending to achieve the same growth rate, right?
Mm-hmm.
Then it's always going to be the one that requires less capital to achieve that growth that's going to get the better valuation, because it doesn't say it takes so much money to achieve that growth rate.
Okay, gotcha. And I'm curious why average total assets is the number there that you're using to basically see the kind of like debt load overall, sort of.
Because the trailing 4 quarters of EBIT is achieved over the past 4 quarters, and so since the asset base changes each and every quarter, because we know that Tesla continues to spend on capex every quarter, right? As they continue to build out Gigafactory Shanghai, as they start to recognize
So
capex
we're
due to
basically
giga.
adjusting the EBIT for the amount of robots they bought and the amount of factories they
Correct.
built to be like, okay,
Yeah.
well, if you had twice as many assets that on your balance sheet, which are factory assets to pump out, but we pumped out 4 times as much EBIT than like our asset, and that's kind of what you're tracking there with this number.
Exactly. Right. Yep. Exactly. Because your revenue as well as your operating profit depends on the total assets that you have, right? So for example, like as Tesla just, announced, another, billion or so in Capex this quarter in Q3 2020, that's Capex that hits the cash flow statement today. But as you know, investments come before the resulting revenue that's associated with it, and therefore the operating profit. So the Capex will be counted today, but if you don't count the average base over time, then what you're doing is that you're front running, the resulting operating profit that comes, because obviously investments happen today, but the results of that investment take about a year or so to get, to actually materialize. And in Tesla's case, it actually happens even quicker. So you have to use the average asset base, not just the most current asset base, to make it a little bit more, a little bit more analytically relevant.
Gotcha. And so what are we looking at here? Tesla went positive?
So yeah, Tesla, so the key takeaway here is not just the fact that Tesla is now, solidly positive, almost at a 5% return on assets level, but even more important is the rate of change that we've been seeing. We saw that they went from basically last place among, global automakers in terms of return on assets because they were unprofitable, for, since inception. They've been an unprofitable company at the EBIT level, and even at the GAAP net income level, even greater. But we see that over the last several years, they have really leveraged that operating scale, so that they can flip the entire business from losses to profitability. And if you see in the next slide, I actually did one thing, which is to adjust out the EBIT, so that we see that before the recognition of regulatory credits.
Wow.
So
did you assume 100% gross
too.
margin for those and just back out the revenue?
Yeah, so I just took EBIT and subtracted out the total credit revenue that they recognized over this entire time period of this chart. So it's basically EBIT trailing 12 months minus the credits that they recognized over the same trailing 12-month period.
Dude, this is amazing homework. The fact that we got to put this on the channel and we got to put this out, it makes me so happy, dude. Thank you for doing this work.
Yeah, absolutely. Because, we hear, and I think it's a valid criticism from the short sellers, is that, Tesla, recognizes tons and tons of credits, and that's how they've achieved, profitability. But, and it's true to a certain, extent, right? Because if we just saw the previous slide, we saw that, return on assets was about 5%. And now if we back out the credits, it's something a lot lower. It's around 1.2% or so. On the current return on assets. However, the more important point or the takeaway here is the rate of change. We've seen a dramatic improvement in the underlying business, even if you back out those regulatory credits. And so if you continue to think that Tesla will continue to grow deliveries, will continue to access new markets, will continue to push down production costs, then I think that this number, even before regulatory credits are recognized, is going to continue to rise up. And so that's why what I did is I compared on the next chart, I compared how Tesla is doing currently, even before the regulatory credits, versus Toyota, which is the industry leader in terms of operating efficiency. And you can see how these two have been dramatically converged. Now, I will say that, Toyota is down this year because of the COVID disruption, whereas Tesla is up. It's a little bit, I guess it's a little bit deceiving to think about because Tesla is starting from such a low base that it's not that hard. I mean, it's definitely not to take away from what they've accomplished, but since they're starting from such a low base, it's not hard to grow EBIT if you just simply increase a little bit more in terms of deliveries. But you can see that, again, the rate of change is what's most important. And I think Tesla is going to overtake, it's inevitable at this point that they're going to overtake Toyota in terms of that return on assets number. So again, this to me is the most important number to understand how efficiently is Tesla utilizing their assets. In other words, what is the internal rate of return that Tesla is generating per dollar of total investments? Okay, so, and that investment is net of all Capex. It's net of any spending that they do. It's net of any, even capital raises, for example. So that's another point. You can see that Tesla rose this quarter in terms of return on assets, but keep in mind what goes into assets, right? What is it? It's Capex, right? It's any purchases of plant, property, and equipment. It's all the purchases of land that they've been doing in Berlin as well as in Texas. And it's also the capital raise that they just did. So this is why this number is so important, because it's the ultimate number to show us what is Tesla earning on all of the capital that they've ever raised, plus all of the capital that they ever generate internally. So this is that number. This is, to me, the most important number to look at any business. In addition to the growth rate, this is the second metric that I look at, is the return on assets. How efficiently are they generating returns per dollar of total assets? And that includes any money that they raise from the debt markets. That includes any money that they raise from the equity markets. That includes any money that they raise internally through their own free cash flow. And really those three things right there. And so that's basically the return on assets that I think is so important to make sure and to track. So again, this is another reason why I think that Tesla stock has surpassed Toyota, is not just in growth rates, but also in increasing efficiency. And I think it's going to supplant Toyota to become the #1 efficient automaker on the planet, as far as, mass manufacturers are concerned.
Yeah. So, and that's kind of where I wanted to go, is where does this go from here? Where is an Apple at? Let's move on from automakers into like really world changing technology companies. What about like a Facebook, a Salesforce, or like, some SaaS company, like where, because I feel like that's where Tesla's going to get with FSD and with all this stuff. Like we're still early in the days. Like you said, all those purchases they're making, like Tesla's still in crazy growth mode. They're 12 startups at once. Almost none of their startups are at maturity. So therefore their return on invested capital, all that stuff is nowhere near maturity as well. And so, yeah, where does this go from here? Because I feel like beating the automakers is kind of a shoo-in at this point and going to be a cakewalk. Now it's like, okay, well, how much further past that do we go?
Exactly, and I think that's the main reason why there's so much investor enthusiasm behind Tesla, is because they see the trajectory of the fact that there is not only increasing efficiency in car design, and so that's why I actually have a couple of slides that just talks about how they are going to continue to increase their asset efficiency, right? The first and foremost thing is on the hardware side, right? And that's basically simplifying car design. As well as improving the manufacturing process. So Elon and Drew Baglino talked about this on Battery Day. Is that with this new cell that they have introduced, the 4680 cell, it's going to take dramatically less capital investments to achieve the same per gigawatt hour of battery output compared to what they're doing right now in Gigafactory Nevada. So.
Ooh, I have some questions on that, because did you see Elon's my video about their new Capex guidance, where they upped their Capex guidance to 4.5 to 6 bill? I'm sure you saw that. And then I put out a whole video about how incredible their Capex spend is per unit of vehicle production to what it used to be. And Elon Musk replied and is like, well, our Capex was trash back then. But then it's kind of like, bro, it was trash back then, but now it's incredibly good. Like if the middle was here, it used to be trash. Now you're like way better than the norm. And I'd love to dissect this with you, because I've been so curious about, okay, we're building cars. That's a massive unit of Capex per vehicle output. If we're going to build the batteries for those cars, that's another massive chunk of Capex per vehicle that we're vertically integrating that's now in-house. Cathode production, mining, we're moving so far down the chain of theoretical value of the car being built, theoretical value of Capex going so much further up, but yet the numbers on paper, it's like, man, Tesla's putting in, it's like they're putting in half as much Capex as they should for all the products they're working. So the only way to explain that as pace of innovation at manufacturing level is that the claims at Battery Day are actually, not too good to be true, and they will have a mega reduction in, Capex per terawatt hour. So I'm really curious what you kind of made of that, because I was expecting them to have to shell out way more to take battery production in-house. And the fact they did cathode too and mining, although those are very small, you see where I'm going with this. But
yeah, exactly. And see,
Elon was being humble. That was my point, is when he said they were trash before, and he's like downplaying how dope they are at it.
Yeah. And I think yeah, that's definitely true. I think there were a lot of there were a lot of growing pains during the initial Model 3 ramp. And we can see that in the in their free cash flow, but also the return on that capex. So another ratio you can look at is simply operating cash flow, relative to total capex, and it hit a low in 2017. And so that's exactly what Elon was basically referring to, is the capex efficiency was trash, in 2017. And it was a pretty dark time in Tesla's history.
Yeah.
Not as dark as maybe 2008, but still probably the second darkest time. But they've just dramatically turned it around, and I think that's the key takeaway there. So yeah, if you look at the ratio of operating cash flow to total investments, right, total capex. And by the way, just a side note for super financial nerds, not all capex. Not all capex is actually recorded on the cash flow statement. So if you look at their 10Q, for example, and if you go to the cash flow statement, I actually have a slide there that just shows that, on average, only about 2/3 of their total capex is actually recognized on the cash flow from investing activities section of the cash flow statement. You can see that, year to date, they've only spent about $2 billion in capex. Where if you recall, going back to the 10K filed in for 2019, the capex guide for 2020, or I think it was for a couple of years, they were saying it's going to be somewhere between 2.5 to 3.5 billion. And year to date, if you just go by what's reported on the cash flow statement, they've only spent about 2 billion. So they're still below, the low end of the guide, but that's not actually the case, because Tesla structures a lot of their capex in the form of what we call finance leases or capital leases. And basically all that is it's just like a mortgage, right? If you buy a house on a mortgage, you just make fixed monthly payments on it, and a portion of your payment is interest, a portion of it is principal. So
that's what they're doing in
delays
Shanghai?
the recognition. What's that?
Isn't that what they're doing in Shanghai? Is this what you're saying with, like, they take on local debt for a factory, and then they would basically, it wouldn't show up as capex necessarily, and they're just paying it off?
Exactly. Yeah, exactly. That's correct. Right.
So it sounds like that's the model they are trying to take more places, but they started in Shanghai. I don't know. I'm curious if you probably know better than me.
Well, I think the land is structured as an operating lease, which is just simply like paying rent. So that's a little bit different. But what they do with a lot of the machinery that they buy, a lot of the robotics that they have, is that they purchase these machines through essentially through a capital lease or a finance lease. So I don't know for sure, but like, for example, the stamping machine that Elon has been talking about for Model Y, for the underbody of the Model Y, I think that is going to be structured. They were purchasing it from this one Italian engineering firm. I think that is structured as a capital lease. Don't quote me on that, but I think it is. But essentially what that means is that Tesla simply, instead of paying for everything up front, Tesla basically pays the supplier a fixed monthly payment, and there's an embedded interest rate in that too. So they're paying a portion of it in principal and a portion of it in interest. So because that spending is delayed, over the course of the term of that finance lease, it doesn't hit the cash flow statement immediately. So Tesla has this addendum, if you see at the bottom of that table there, where they disclose how much of plant, property, and equipment, essentially capex, is structured as a capital lease or a finance lease, also known as a finance lease. So if you add that in there, then it's a total of 2.9 billion that they've spent year to date.
That's the 913 mil. That's exactly the number that isn't in capex, but is basically capex.
Correct. Right.
Interesting.
Exactly. It's basically capex. So that number goes into the balance sheet as a part of total debt that they have. So if you look at their balance sheet, if you look at their current debt as well as the long-term debt, that's not just debt that they owe to bondholders, but it's also the present value of all of these capital leases that they have outstanding. So you can think of it just like debt. It essentially is debt, but it's just structured in a different way.
And so when you gave us the Tesla unlevered free cash flow, adjusted EBIT minus CapEx minus capital leases, you're essentially trying to take that into account as well? Or can you show us what this number is? Because I usually off the bat, I'm like, EBITDA, I hate that, because like we should be taking into account DNA, because like we spent the CapEx to get this EBIT. So let's have the, we
Yeah,
should be counting
exactly.
the DA, like, so I hate EBITDA usually, but I'm like, I know there's a lot behind this number and the way you think about it. So
yeah, so this unlevered free cash flow is another way to think about the growth of Tesla. And the reason why I use adjusted EBITDA in the starting point is because I still think that that is analytically the superior number for understanding Tesla's operating profit, because of three factors. One is Elon's bonus, right? So, with that bonus that was passed in 2018, I think that because of that above average stock-based compensation expense, if you are overly focused on GAAP net income, then you're going to consistently underappreciate Tesla's true underlying operating profitability.
but there's a friction to that underlying profitability, which is the cost for that incredible CEO, which is Elon, which is amortized in that stock comp, which is why it would be a justified expense, in my opinion. Would be like, yeah, like, okay, it's not the core business, but it kind of is, because the core business wouldn't have crushed it. We didn't have Elon and we had to give him the stock package. So yeah, we should kind of.
That's
right?
true. That is true. And that's a valid point, and that's why it's included as a part of GAAP. But what it does is that it distorts what Tesla is fundamentally doing. So yeah, I agree that, ultimately you have to have positive and growing GAAP net income in the long run. But for analytical purposes, right, if you are just focused on GAAP net income, then you'll miss what's actually happening under that layer of, a short-term above average expense, right?
Yeah. Because there's a
So
lot of
just for
fascinating
analytical purposes.
like things to unpack there, of almost like Elon should have a key man risk, because now we're like literally like mathematically showing his value almost to the way it's like Tesla's like, okay, they're like industry average, but they're actually super profitable, but we're baking in like this extra CEO stock comp for a genius CEO. And that's really what's happening with the cut. It's like, I love
exactly.
nerding out on this, by the way, because this is
Yeah.
so fascinating. Like, Tesla's so unique in many ways. That's why I think almost every company is so unique. That's kind of my theory, is like comps are BS. Like every company, when you get down to it, is so unique, especially Tesla. Like it's just, the CEO stock comp, the tie-in, all that. Anyway, I didn't want to get us too sidetracked there about the free cash flow.
And just a side point to that too, is that if you're, again, like I think, one of the investors that I follow very closely is Bill Miller, who heads up Miller Value Partners. It's a hedge fund / long-term investment management. He's kind of like another Ron Barron, so he's a phenomenal investor, and he actually understood Amazon very early on, and he basically has said in multiple interviews that I just don't place too much emphasis on GAAP earnings, because if you do so, you're going to miss other things that are happening under the scenes or behind the scenes on that. So if you look at a chart of Amazon, it's had exponential, growth in the stock price. But if you look at that relative to their GAAP earnings, it's been like, it's constantly confused people into thinking that the stock is dramatically overvalued.
Dude, you got me so hyped. Keep going.
Yeah, but if you look at EBITDA, for example, on Amazon, that tells you a different picture. So, and by the way, even as recently as 2015, which is not that long ago, it's not as if, Amazon was a brand new company in 2015, but, 20 years into their existence in 2015, they reported a GAAP loss on an annualized basis too, not just for a quarter, but for a full year. So if you're looking at GAAP, you're gonna miss too many things that are happening. So I think it's sometimes important to look at other factors that are slightly above the GAAP net income line, such as EBITDA, such as operating cash flow, even free
Yeah.
cash flow.
Operating cash flow. That is the first line that is in Amazon, every Amazon press release. And if you look at the operating cash flow and kind of adjust for Whole Foods and stuff like that, that is almost perfectly predicted. The stock price is like gross profit and, operating cash flow multiples. And you can see just like a formula, the stock is following the increases in those metrics, which is so fascinating. And I love, so that's why I'm like, I did the whole Elon Musk, playing devil's advocate with you for Gap, but I hate Gap. You know what I mean? Like, I'm also the guy who's like, look at Amazon, like the Gap isn't doing justice to have the true core intrinsic earnings power of this asset, which is the same for Tesla. And with Tesla is so fascinating is Amazon, okay, but I love the comparison in the early days of like, well, Amazon reached free cash flow profitability faster than Tesla or sooner than Tesla, or Tesla's free cash flow is worse. I'm like, that's because what they're doing is 10 times harder than putting books in a warehouse that you don't have to do anything with. They actually have robots in the warehouse that are building things instead of just piling up books there. Of course, the cyclical cash flow profile is like a much bigger dip at the beginning for each factory and each thing, but it's going to be much more, and I'd say the moat's stronger. It's going to take long to replicate. Like, this is just, in many ways, this is a lot more similar to Apple with the retail consumer side of it, and Amazon with the Capex investor story, invest every dollar of free cash flow into growth side of it. This is an Apple, Amazon-esque strategy play, much more than it is any automaker, is when you look at the cash flow and really unpack this. And so that's why I love this asset and this chart that you showed here, is because you're basically replicating the first line of Amazon's press release, which is the adjusted true sort of operating cash flow of the business, which is what, if I'm right, you're trying to show us here. So if almost like, if I'm pitching Martin and Tesla, I'm like, yo, if we're trying to really scheme a la Amazon here and readjust what is the first metric of our quarterly press release, is it this metric right here? Mayur would say, yeah, probably, right?
Yeah, I think so. But really, let me back up a little bit. The idea of this, though, is just in the short term. I don't actually mean this to be the ultimate number, starting with adjusted EBITDA. The only reason why I'm showing this now is because of those three factors, right? That I believe is going to be artificially depressing earnings. One is the above average stock-based compensation that's attributable to Elon's bonus structure, but also because of above average capital spending that we're going to see in the coming years, which increases the depreciation that we're going to see on the income statement coming in as well. So one thing that EBITDA does is it tells you what the operating profit is before the effect of all of the high-end capital investing that the company is doing. So, for example, if you are focused on GAAP earnings, then you're going to, in my view, incorrectly penalize companies that are radically investing in their own business, that are investing for growth, right? So if for a company that's investing a lot in Capex, it's going to come up on the income statement as lower income or lower profit because of the fact that they are recognizing higher depreciation expense. So adjusted EBITDA helps adjust for that as well, to understand, what is the growth and profitability, assuming or ignoring the expense that's coming from depreciation of all of that spending. So again, it adjusts for that too. So it kind of presents a smoothed out version of profitability that you can use to compare, one company to another.
I have a question.
Yeah.
With cyclically low super low cyclical interest rates is now almost a unique time in history where mathematically it actually makes way more sense for a longer term investor to go basically all in with your cash flow to invest in crazy projects. It's almost a red flag if in this low interest rate environment you're holding cash flow back and buying back stock and letting it pile up on the balance sheets. Like, you really don't have anything to invest in, especially with this low of a hurdle rate. So I'm wondering if that timing of interest rates is kind of putting us in a unique era of like the Amazons and Teslas, like mathematically and strategically because of the interest rates, this is the time to do that kind of cash flow strategy.
Yeah, I think so. But unfortunately, not everybody knows or has an idea of what, high return projects to chase, So, not everybody actually has that expertise or that wherewithal or that savviness to do that. And that's why we see, not many auto companies are investing heavily in R&D or in Capex for building out electric vehicles. And it's kind of another unfortunate thing is because of the pandemic, right? Everyone's profitability is down dramatically, except for Tesla. So usually what happens, and I think, Kathy Wood actually talks about this pretty often, is that recessions actually accelerate innovation because everybody else is asleep at the wheel. to keep their profitability up. So they find places to cut, and growth projects are the first place that they cut. For
Dude.
example, I
Yeah.
rail on ExxonMobil all the time. ExxonMobil is the worst. Like I really think Exxon is actually going to be the first victim of the rise of Tesla and renewable energy in general.
Oh, they're going to go bankrupt, right?
I think, I mean,
I think they will
I don't know
too.
if they'll go bankrupt, but I think that they're going to be a fraction of the size that they once were.
Bro.
And it's
Grammy, did you hear
because,
that? My grandma still has Exxon stock. I've been trying to get her to sell. I'm like,
oh my God, you got to tell her to dump it.
right?
I
Like the
mean,
dividends.
so like,
I'm
here's the
like,
thing,
dude,
though.
the dividends. Like these are inflated dividends. It's like a rug. They're gonna sweep out from under you. All these old people are like waiting for the dividends, and they're just gonna go, and then
Yeah.
And it's like, so I'm really worried about that's like Procter and Gamble, Coca-Cola. I think half the reason, not just brand value, those are inflated on all your metrics with a premium.
Yeah.
Because that dividend aristocrat kind of legacy shareholder base. But
Exactly. Yeah. I mean, Exxon is spending more on dividends than they generate in free cash flow.
like, how is that not a red flag? Their dividends keep going up and their cash flows off a cliff. It's like, bro, like this just can't continue. Like, it's not rocket science here. Like, what's their payout ratio? Like,
Exactly. And the worst thing about it is that they're actually spending, because dividends exceed free cash flow. The only way you can make up for it without depleting your cash balance is to raise more debt. And that's exactly what they've been doing. They've been issuing debt to finance
keep the dividend,
kind
of. Yeah, dude,
right?
It's like you think about that as a shareholder and you're like, dude, this is so moronic. Like, and then they're going to tell you that Tesla's a risky investment and Exxon's not if you go to business school, up until Exxon implodes. That's going to be nobody's going to tell you that 5 years from now at how insane you were for saying I put all my money into Tesla, not the dividend Exxon. When in my business school, it's like, so it just, to me, this is a fascinating example of a microcosm of the whole way the financial media works. It's all the rear view mirror. It's all what happened. It's all these people saying they were super smart, like analyzing something that did happen. Nobody's got the actual foresight and kind of like bravery and courage to actually put their nose out and say where the future is going. And that's why I give you so much props, is because you and me were over here like banging the table on Tesla before the charts look good. You know what I mean? Now it's easy for you to do your job because the charts are looking amazing every quarter. But to me, what is amazing about your analysis and why we clicked like so long ago is because we're saying that, like, it's not easy to say Tesla's going to be the most profitable, break every rule, grow super fast, have super high margins at the same time company when none of the evidence is there and the cash flow is $1 billion negative each quarter during the Model 3 ramp. Like, that's how you get alpha is by so I don't know. I'm kind of, maybe this is a good moment to take a step back and like on your reminiscing of you've been here, started from the bottom when Tesla was losing all their billions and investing in it. What have you kind of learned from that?
I mean, I learned that, I don't think it's important to constantly look at, cash burn or GAAP net income. So it depends on why. I think that the more important question is why. Like, why are they burning cash, or why are they losing money at the GAAP net income level? If you see a company that's investing heavily in growth, then I think GAAP net income is an irrelevant metric. And we've seen that through the example of Amazon, 20 years ago, 25 years ago, where they were so heavily focused on growth that they didn't care that they were showing negative earnings per share. And again, like I said, even as recently as 2015, Amazon was not some new startup in 2015, right? But even as recently as 2015, they showed a GAAP loss. But if you look at the financials, you understand why they've been doing that. And that's because they were bringing AWS to market. So they were spending, billions and billions of dollars in R&D to build the best cloud computing, service that, exists out there. And now we see the result of that. So the investments always hit the P&L first, and then we see the resulting, scale, or we see the resulting profitability through scale. So that's why when I was looking at, Tesla financials, 3 years ago, and we saw nothing but red ink everywhere, I saw that, okay, well, what's the most important thing to focus on? Which is at that point, revenue growth, right? Revenue to me signifies what's the level of market demand for the products.
Yeah.
Do people love the products? Is there value being created from these products and services? Is there a network effect, right? Do people that buy the product recommend the product to others? And to me, Tesla was checking off all of those boxes. And then if you look further, you can see that they were heavily investing in Model 3 production capacity, which is a more, mass market vehicle compared to the Model S. So why would you hold that against Tesla because they're losing money on investing in products that will make them more ubiquitous than they currently are?
Yep. And even
So
though we say
yeah,
the capex was trash, 4 billion in capex for a vehicle program of the Model 3 that does what, 10, 12, 14, 15 billion in revenue per year. Like even that's not even that, you know. I always thought the analogy was so simple. It's like, what's Tesla doing now? Buying all the robots to build all the cars. You know, we can't build a gazillion cars if we don't have the biggest factory, state of the art, with all the fanciest new robots in the world to pump them out. And guess what? You know, all these people who are like, look how much money Tesla's burning. I'm like, have you ever tried to build a car factory? Like, plan it out. Step one, get a really big lease. That costs a lot of money. Step two, like, go get like the stamping machine. Like, oh, and we need like a truck dock for all the aluminum to come in. And then we're going to stamp the aluminum. Actually, wait, we need a whole team of scientists to develop a new type of aluminum so we could stamp it cheaper. Like, and then we need to store all that aluminum in this thing. And then it's going to put a body line here where we need 10 more robots to put, you know, it's like, you actually start thinking about it. It's like, dude, that only took $2 billion. Like, that's nothing to actually, you know, it's like what you're saying, like, why are they spending money? It's not like they're like, you know, like, it's not like a boat that's sinking that they're trying to keep afloat. It's like one boat is perfectly afloat and they're building 50 new boats at once to expand,
right.
you know? And it was kind of that unpacking and yeah.
Yeah, and unfortunately, not enough people understand, you know, growth companies in that regard. So that's why, you know, that's why for many years I've been focused on adjusted EBITDA. And if you look at that number, or even operating cash flow, for example, adjusted EBITDA and operating cash flow have a very high correlation to one another. So if you looked at, instead of looking at GAAP net income for Tesla, if you looked at adjusted EBITDA or operating cash flow, that was telling you a different story. Because operating cash flow, just like adjusted EBITDA, adds back depreciation expense. It adds back stock-based comp. It adds back all of these other non-cash expenses that Tesla, you know, that hits the P&L. So once that's done, you can actually see with a lot more clarity what the underlying profitability of the company is, adjusted for these types of things such as growth investments. But now you can see that it was, you know, massively negative in the red in 2017. If you look at this, you know, this Tesla unlevered free cash flow chart, and that's again what Elon was talking about, that their capex efficiency was really, really bad in 2017 as they were investing in, you know, bringing Model 3 online. But you can see now that that entire model has flipped and is growing positively. And this is actually adjusted for not only capex that I just mentioned on that's coming from the cash flow statement, but also all of the capital leases too that they're using. So this is adjusted EBITDA net of total investments, all of their spending that they're doing. And that's positive as well. And it's not only on unlevered free cash flow, but it's even on levered free cash flow too. So if you look at the traditional calculation of free cash flow, which is operating cash flow minus capex and minus all these capital leases that they have, even that number is positive now. So it's literally a cash generating business at this point, which I never thought that they would actually do at this stage. My original financial model that I made some 3.5 years ago, I didn't expect them to do this until 2021. So Tesla is way ahead of my own expectations too in terms of free cash flow generation ability. But you know, going back to it, you know, growth again is really great. Growth is sexy. That's what generates all the headlines. But efficiency is what ultimately reigns, you know, supreme. How much are they generating in profit? How much are they generating in cash flow? How much are they generating in free cash flow per dollar of total investments?
Right.
And that's what I use assets to measure. That is the true internal rate of return that a company is compounding its capital at. So how does that continue going forward, right? I think that, you know, Tesla has disclosed this multiple times through their various different shareholder, you know, decks that they've put out. But we can see that, for example, on this slide, slide number 24, you know, they've radically redesigned the Model Y such that it's going from basically 70 pieces, right, the Model 3 to just 2 pieces on the rear underbody, and it's eventually going to be just 1. So that is a dramatic simplification of the structure, the body in white, the structure of the, you know, of the actual car itself, to reduce the amount of Capex that's needed to make these cars. And now we talk about, now Elon's super excited about this die-cast machine. I think that's going to dramatically improve labor efficiency too. So like, how many people does it take to build each car? That number is going down and down and down. So again, that goes to efficiency again. How much money does Tesla need to spend to produce each car? And, in another shareholder letter, they kind of showed that graphically. They didn't show us the y-axis. If you're wondering why there's no y-axis there, this is slide number 23. Mm-hmm. But, they didn't actually show that because I don't think Tesla really wanted to disclose exactly how much it is per car, Capex per car. You can see just relative to each other, Model 3 in Shanghai is about half, the total Capex needed per unit of capacity. And Model Y produced in the US is somewhere just, slightly above that, but still dramatically less than the total cost of the Model 3.
Yeah. And I love your other slide.
Yeah.
Your other slide, I'm going kind of fast here because I feel like we're almost out of time, but this, the factory layout of Fremont, this like super old school like piece of crap that we bought from GM and had to retrofit, to like designing it from scratch in Shanghai, and just the way that's ramped and just proved every skeptic and hater wrong. And just in some ways I love the simplicity of how complex this story is. And then it's like, oh, why is Tesla so much better? It's Capex. Like, instead of the factory being like laid out and just a mess, we just laid it out in a straight line like this, and that actually just like saved us a whole bunch of time and money. Or like the tabless electrode, like instead of having this tiny wire, it was just like all a bunch of wires, and we just, and that made it so much simpler. So it's like there's so much that goes into it, but in some ways I love those kind of analogies. And I had forgotten about this. I feel like this is the one of the things we all talked about when Shanghai was ramping. The Capex came in that was incredible. We all forgot why. I already forgot this slide. That's why I was like, ooh, when you showed it. But I think this is another one. And what they're going to do in Austin, dude, the crown jewel of Tesla, literally the world's dopest factory. I think Elon, I am so excited for what they got up their sleeve in Austin. That's going to be insane. Okay, so we're Tesla investors. All said and done, how would you fairly value Tesla stock today? Because we have the rapidly growing vehicle business. I would say that's grown, frankly, far more profitable than we would have expected. The FSD pricing power is growing far more faster than I expected, and the timing is, frankly, far more faster than I expected. Like, I know it's like late by Elon time, but it's way ahead of what I was expecting, Mm-hmm. And then we have Solar Roof really finding gear, Megapack. Like, I'm really thinking Tesla at 390, 400 billion is actually, we missed that 10 bagger pop, or actually we didn't miss the 10 bagger pop. We've been in it, but is it going to easily 10 bagger pop again? No, but do I see a structural like 40 to 50% IRR CAGR for the next decade still from here to a $5 trillion company? Yes. And that's why I frankly think as big cap tech goes, Tesla's the new blue chip iconic. It might take another year for people to realize that, where it goes up another 50%, but that's where I think it is. The product market fit took them 15 years to get there for the EV industry. And now they've gone 0 to 1, it's 1 to N, and we're going to go to 200 billion in revenue, just like that, from scale without any competition, basically. Maybe let's call it 150 before FSD kicks in. And it's like, this is quickly going to justify. And then you do the free cash flow numbers, the return on assets, the $1 billion FSD a quarter calculation. I'm like, this 1% yield, 2% yield of free cash flow that's growing like crazy in this interest rate environment, and the relative valuations of every other company. Where do I want to keep my money as just a human on earth? Like, Tesla equity. So I don't know. This is kind of my long-winded, very high level way of saying, like, because Tesla has executed the intrinsic value of the business has gone up so much, I'm actually still thinking like it's very fairly priced at today's levels. Despite the equity rise. Like, I think just the business has increased in value that much. And so that's kind of how I think about it. But I would be really curious to think about, how do you get to a fair value of Tesla today, and think about that valuation question?
No, it's a great question. I think, I tend to agree with you that Tesla is relatively fairly valued right now, until we know a little bit more about how much FSD is going to truly contribute to operating profit and net profit for Tesla. So again, one of the reasons why Tesla traded such a massive valuation multiple relative to other auto stocks is that there is a combination of growth that's being priced in, as well as that asset efficiency. Again, that can be attributable to better design. It could be attributable to better manufacturing technique, and it can be attributable to rising share of FSD of, total operating profit too. So, and I'm a little bit, I'm a little bit still skeptical of the timeline for robo-taxis. I don't think that's going to happen anytime soon. So, but that's not to say that FSD is not going to contribute meaningfully to profit, and therefore return on assets, because there's still a lot of utility in having FSD, right? So that there's still, the individual will still benefit, a lot from having the features of FSD on their cars. So there is enough incentive for people to continue to buy it. And as
and they're raising the prices. I don't think the take rate's going down. Like, they've been raising prices. I think the take rate's probably staying flat. Like, this is a true, the incremental gross margin expansion from FSD, we do not need full autonomy. It's already underway. It's just all incremental gross margin expansion till FSD. And I think the market is like, oh, well, what was the one-time, FSD revenue recognition this quarter? It's like, bro, this is such the wrong way to think about that line item.
Yeah, exactly. And see, this is why I really wish, and if you talk to Martin, if you're watching, shout out to you, but if you really, really hope you guys consider breaking out FSD from automotive sales, because software is such a different animal from manufacturing. Even though the two are related, right? You can't buy FSD without buying the car. But I think it's going to be important for investors to understand that there are gains coming from operating profit due to not only FSD, but due to all the slides that we just saw in terms of manufacturing efficiency and simplification of car design, that I think it's going to go underappreciated if we don't really understand that, where the operating profit is truly coming from.
Wow. So, and that would be truly the start of Tesla being understood as the computer on wheels company, in my opinion.
Exactly.
Is when we truly acknowledge this massive and not going away piece of the software business.
Yeah, exactly. Because Amazon does it, right? Amazon breaks it out. Even though technically you can argue that AWS is unrelated to the retail side of things. But they still show it though, because it is a different animal entirely, right? It requires an entirely different set of skills, and different know-how from actually building the cars themselves, right? So the team of engineers that designed the Model Y and designed the Cybertruck and whatnot are completely unrelated to the team that's working on FSD, right?
Yeah.
So I wish we saw that, but yeah, I think that the trajectory that Tesla is on with achieving the industry best return on assets, but not just achieving just the best in terms of overtaking Toyota, but I think it's going to achieve more than 10%. Right now they're at 5%. And despite the fact that they're going to be spending $6 billion every year for the next 2 to 3 years, I think that the return on assets due to increased profit due to FSD, as well as better design and less Capex that's required to build these subsequent factories, as well as the improvements that are coming from the 4680 cell, I think Tesla will achieve 10% return on assets by the end of 2022.
Wow.
And if that happens, then I think there's still a lot more upside to go with Tesla equity. How much exactly, I can't tell you for sure, but I do think that if that happens, if we use Amazon as a comparison, then I think that there's a warranted for another doubling in the stock price, by 2022.
Wait, I kind of have a crazy moonshot. Would you ever work for ARC Research? I feel like ARC, you would crush it at ARC, like crush it.
Well, I certainly look up to those guys a lot. I own ARC, the shares, ARKK. That's another big part of my portfolio. So I think, what Cathie Wood has built is phenomenal. And I really like the way that she thinks, right? She doesn't, she's not focused on the traditional business school metrics that people like to look for. She thinks in terms of, what companies are going to thrive by creating value and addressing big problems. Like you always say on your channel, the bigger the problem, the bigger the opportunity.
Yep.
Right. And if you focus on companies that are basically thinking like that, then that's, I think, where the true alpha is created, because these companies are so misunderstood. Like we knew from Tesla, the entire experience that we've had from Tesla, it's been dramatically misunderstood. It's had, incredible, presence of short sellers that, were pushing it down. And, even, in 2019, I remember listening to Adam Jonas's conference call, right? He had this emergency conference call where with all of Morgan Stanley investors, and he basically called Tesla a distressed equity story, right? And I was listening to that, and here I am with 80% of my net worth tied into Tesla, and I'm listening to this respected analyst talking about Tesla becoming a restructuring story, which means that they're going to have to restructure their debt, which is never a good sign. That's a sign of impending bankruptcy. But I think it's because people were not focused on the right metrics, right? People were not focused on EBITDA, for example.
Or too focused on the metrics almost at a point in the company when you really should have just been focused on the product. I don't know. I come from that world of we're diving so deep into the numbers, but get your head out of the spreadsheet, drive the car. It's amazing. This is the future. It's a startup. Let's give them more money. This is a no-brainer from a VC mindset, And so exactly. I feel like that kind of just they couldn't use with their brains, walk through every line of the cash flow thing without I don't know, having a heart attack, I guess, because it was so much red that literally, and I feel like Jonas was the same way. And so, that's why it really frustrates me. They still let Jonas and all those people on the conference call in some way, because it's what is this? Why isn't this a conversation on the next conference call where it's Elon, are we going to think about breaking out FSD revenue? That would be dope. Have you thought about that?
Yeah, absolutely. And one last point, by the way, and this is another thing that I think is going to contribute to Tesla increasing return on assets specifically over the next year. And that is that although the new cell, the 4680 cell, is not going to achieve high volume in the short run, I think what Elon said is that it's going to be able to produce enough new cells or incremental cells such that they can actually sell more cars. Because if you look at the most recent shareholder deck, right, for Q3, there's a little table that they include in there that tells you what the total production capacity is today.
Yeah. That's a very key table.
Capacity there is. Yeah, and as of Q3, they have production capacity of 840,000 cars, 90,000 of which is Model S and X, and 750,000 is 3 and Y globally. But as we know, they're nowhere near producing as many cars right now. And even before Q3, it wasn't 840,000. I think it was I can't remember off the top of my head now, but it was around 700,000 cars. But even with that, Tesla is still nowhere near producing that many cars, even though they have installed capacity to build that many cars. And the real reason for that, or the primary reason, is the production bottleneck for batteries, right? We don't have enough batteries to be able to produce this many cars. But we do have the robots in place to build those cars if we had the batteries to supply them, right? So what this is going to do is even with 10 so even with 10 gigawatt hours, which is I think the guidance that Drew gave, or it might have been Elon, in terms of production output from the Cato facility for the new 4680 cells, even with 10 gigawatt hours of production coming in over the next year, that's going to enable Tesla to sell that many more cars. And it's not going to take a whole lot of additional Capex to do it, because they already have, installed capacity to build 840,000 cars. So what that means, in my view, is that that's going to be accretive to operating profit, and therefore accretive to the return on assets that they do, because they're not going to have to spend too much additional money to realize that additional output from the existing factories, because it's already there, it's already spent, it's already installed, it's ready to go. It's just waiting for additional cells to be able to power these cars.
Yeah. So it's almost like Tesla's the metrics aren't even as good as they should be in some ways, kind of what you're saying, because we're underutilizing our production lines, economies of scale over that fixed, asset base. That is so exciting, dude. Thank you so much for taking the time. I feel honored that you share all your data with the hyperchangers, and I get to pick your brain on this, because it's so much fun, so epic. So I don't know, do you have any final thoughts or shout outs? I'll put your Twitter below. People should definitely give you a follow. But yeah.
Shout out to James Stevenson and Eric Simon. So those are my buddies on Tesla Twitter. So
Hell yeah.
love talking to you guys. Love talking to everybody on Tesla Twitter. JPR is another guy. Great research, a lot of stuff. Matt Smith too on the energy side. Love his work too. So check out his YouTube channel as well.
Dude, awesome. Well, thank you so much, Mayur. This has been a blast, and I'm going to try and tweet out all these charts. People should definitely hit you up with more questions because you put out we just scratched the surface on all this. But have a great day. And yeah, thanks again. Peace out, Mayur.
All right, man. Peace.